Hey, it's about 10:40, and looking at emerging market stocks coming into the week after a rough sled in Asia last night, with India down another 2.4%, Indonesia down 4.5%, the Philippines, so a lot of the high flyers of last year making a big move down. We've highlighted this in the last couple of days. What's really going on. I think the first and foremost is that inflation is a very difficult reality for a couple of these countries. They're importing commodity inflation. They have significant food pressure and social issues related to that at home. So the other big thing is always what it comes down to for me is that valuations look a little stretched here. So continue to see market players not necessarily running for the door, but I think there's a bit of a buyer strike, and I think that there's a lot of uncertainty when you layer in some of the global externalities this morning coming out of Europe. A lot of rhetoric over the weekend, not new, but also we haven't really seen it front and center in a few weeks, which is that EU periphery has to refund significant bond auctions this week, Portugal being pushed to the table to accept the bailout, and that has a lot of people pulling back. If you look at global markets here, as shown by the S&P, I think you have to really watch the 1260 level on the S&P. Any pullback from there, I think it takes you all the way back down to 1220. So the currencies remain where I'd focus a lot of attention. The Dixie is more or less flat. I'm surprised by the euro resilience this morning, but again, if you look at Southeast Asia, maybe this is the beginning of the cracks in the total credit story that we've warned you about for a couple months. I don't think this is a first quarter or maybe even a second quarter event. I do think it's a second half event when you look at emerging and then look at the inflation and the impact on credit. Finally, Brazil, Manteiga, continues to push of a trade war conversation, a currency war. The WTO is his next place to bring this up, but the conversations over the weekend and in the FT today say that Brazil is very unhappy with their largest trading partners, the U.S. and China. And as I noted on the site this morning, isn't this really more about the strength of the Brazilian consumer and the consumption growth that goes on domestically that has had a big impact on their trade deficit. Their trade deficit with their largest two trading partners is something that has them unnerved. But a lot of this is less about the currency manipulation they talk about than it is the domestic story. And be careful what you wish for, because they have a strong and resilient domestic economy, and this has a lot to do with what's happening. Keep you posted. Talk to you.